Chapter 9 is looking at the master budget. And we talked about this at the beginning of the course when we talked about the 3 primary responsibilities of a manager: planning, directing, and controlling. This is the most obvious example of planning. Okay. So you may do a budget for your personal finances. Maybe you don't, and it would be a good idea if you did. Companies definitely have to do budgeting. They have to determine how they're going to use their resources, where the resources are going to come from. So we have to estimate our future costs and our future revenues. And we have 2 approaches to budgeting. One is incremental budgeting, the other is zero-based budgeting. Incremental budgeting is pretty commonly used. We create a new budget based on changes from last year's budget. So it's pretty easy to incremental budget. We can see the changes from the prior year, pretty easy to identify. Disadvantage, if you had a bloated budget last year, it's going to be even more bloated this year. We don't have an incentive to reduce costs because we just keep on upping last year's costs. And so we could lead to some wasteful spending using an incremental budget. A zero-based budget is where you start from scratch and you have to project what all of your costs are going to be. So this one, we're not going to have just the increasing budgets. We're not going to repeat our past mistakes. It makes us look at what we actually need. But this is going to be difficult, very time-consuming to prepare. Approaches to budgeting. So companies can use a combination of both approaches. So we can use what we've done in the past as a guide. We might use zero-based budgeting for specific parts of the budget. Or we could, every few years, just start from scratch, do a zero-based budget, and then do an incremental approach for a few years after that. So that would eliminate the consistent just building on to previous years if we say every 5 years we're going to do a zero-based budget. Okay, so we could have top-down or imposed budgeting where the budgeting process is determined by the upper management. And so you have the executive deciding what the budget is, and we just let the rest of the organization know that this is what we expect of them. Bottom-up or participative budgeting is where we let managers of all levels contribute to the budget. And so usually you have a mix of both methods, right? You do want to get the involvement from all the different levels. You want them to have buy-in where they can say that the budget makes sense, is attainable. So you don't want to just tell them this is what it is. Plus you have the managers, they're closer to the operations. They have an idea of what's realistic, so you do want to get their input. So which of the following is an advantage to zero-based budgeting? Relatively easy to administer? No, it is not. Changes from prior year are easy to identify? No, that would be with the incremental budgeting. Difficult and time-consuming to prepare? That is true of zero-based budgeting, but that is not an advantage. It forces managers to perform a comprehensive analysis of all operations. So you're really looking things over, finding the inefficiencies. Budgetary slack. In the classroom, I show a cute clip from the office. I won't show that to you here. But budgetary slack, and this is why you don't want to just have bottom up. You do want to have upper management involved. Employees, they want to underestimate the revenues. The salespeople, their bonus is based on whether they hit their goal. So they want to set the revenue projection lower because they know they're going to hit it and exceed it. Or you want to overstate expenses. So you know you won't go over budget if you make them too high. So we don't want, that's what the budgetary slack is. We don't want to have that into our budget. We don't want employees suggesting things that they know are going to be easy to meet. We want to have them difficult but attainable. So benefits of budgeting, we can forecast what's going to happen in the next year. We can communicate our plans to the rest of the organization. And then we can do the control responsibility of management. After the year is over, we can compare the actual to the budgeted, and we can kind of see how we did. Okay. So we are going to be looking at actually all of the budgeting. The operating budget is the pieces of the budget that contribute to the lines on the income statement. Okay. Capital budget, look at the company's financial resources. This is the detail for the budgeted balance sheet. Cash budgets is going to be contributing to the balance sheet, right? Because that's where we see cash. And the master budget is all of the operating, capital, and cash budgets combined into one master budget. So all of the supporting budgets put together make up the master budget. We're going to start off by looking at the operating budget. This is where we budget for all of the things on the income statement. So we've got the sales budget is what we base our entire budget on. So this is going to be the most important budget. We have to project what we are going to sell because everything is based on how much we're going to sell, right? That's going to determine what we need to produce. The number of units we need to produce is going to determine our manufacturing costs, direct materials, direct labor, manufacturing overhead. And then we need to budget for our period costs, our operating expenses. And all of this information will then be used to prepare a budgeted income statement. The financial budgets then are going to be used, are going to be prepared based off of our budgeted income statement. Okay, we will be determining what we will be able to spend on capital expenditures. We'll be able to see how much cash we have based on the results of our budgeted income statement. We'll see the cash that is coming in through revenue, the cash that's going to go out for cash payments for manufacturing costs and period costs. And these will be used to prepare the budgeted balance sheet. Okay, so our starting point, the operating budget. First off, we have to prepare the sales budget, and as I said, everything else is based on the sales budget. So we have to do the sales budget first. The sales budget itself is easy to prepare, but it's the forecasts that are involved in determining what's going to go on the sales budget are going to be a lot of work because they really need to be accurate because we're basing everything on our sales projections. But once we have our sales projections, we've projected what the volume is, what the selling price we're going to be able to charge. The sales budget itself is super easy to prepare, right? We just take the number of units sold, multiply it by the sales price. That gives us our total sales revenue. So here's an example. The sales budget, we know how many units we project, multiply that by the selling price per unit. Here's the quarter one, 4,900 units times 50. Here's our quarter one revenue, 3,900 times 50, quarter two. So that's pretty easy to prepare. Okay. But we will then find out that as we operate, our actual sales volume is probably going to be different from the budgeted amounts. Right? There could be a change in demand, decrease in our market share. Perhaps some competitors enter the market. There could be an economic downturn, right? We can look at what happened with COVID-19 and the shutdown. What did that do to everybody's budgets? After the sales budget, we prepare the production budget. Okay? And so the production budget would be what you prepare if you're a merchandiser, the purchases budget if you are a merchandiser. So our production budget, we need to figure out how many units do we need to make. So obviously we need to have enough units so we can meet our sales demands. But we don't want to just have enough on hand to make our sales demands. We want to have a little bit of cushion. We do want to have an amount of ending inventory left at the end of the month. So the desired ending inventory is determined by the managers. Usually it's a certain percentage of the production for the next period that we want to have in our desired ending inventory. So the units we need for sales plus our desired ending inventory, that's the total units we need. We're trying to figure out what we need to make. Okay? We don't have to make all of these because we had some units in beginning inventory, right? Whatever we had in ending inventory last period became this period's beginning inventory. So we subtract that from the total units needed. That's the units we need to produce. So here's an example here. The sales volume of 4,900. And one thing that I need to point out with the production budget, this is the only budget that our result is in units. Everything else is in dollars. This is telling us how many units we need to make. So we can see the sales volume from the sales budget, add our beginning inventory, add our ending inventory that we want at the end of the month. That gives us the total units needed. But then we subtract our beginning inventory, and that gives us the units that we need to make. So let's take a look at an example. They forecast sales of 125,000 units in December, sold at a selling price of 60. Here's the units to be sold in January and February. Okay, they want to have ending inventory equal to 10% of next month's budgeted sales. So we're going to start off with the sales budget and production budget, well, sales budget first for December. So our starting point is the number of units sold. So in December, we project we'll sell 125,000 units, and they will be sold at a $60 selling price. So we will multiply the units sold times the selling price of 60, and that will give us our total sales revenue. So that's how simple it is to prepare the sales budget once you've done the hard work to determine the sales forecasts. Now that we know that what we're going to be selling, we can go ahead and do the production budget. So the starting point in the production budget is going to be our units sold, right? Because we want to make sure we've got 125,000 units that we've made that are ready to sell. But that's not all we want to have. We also want to have some units in our ending inventory. And so we're told that they want to have 10% of next month's budgeted sales. So we want to have 10% of January sales in our ending inventory. And in January, they estimate they'll sell 110,000 units. So we want 11,000 in our desired ending inventory. So our total units needed is, what I meant to do, 125 plus 11,000. Total units needed are 136,000. So we need 136,000, but we don't need to make 136,000 because we had some units at the beginning of December. So our beginning inventory, okay, we would have ended November with 10% of December's projected units sold. So our beginning inventory would have been 10% times the December units sold. We would have had 12,500 in inventory at the end of November because that's what we would have wanted for December. We would have wanted 10% of December's in our ending inventory. So our units to produce will be our total units needed minus our beginning inventory of 12,000.